All right, so in this video, we're going to be talking about the silver bullet entry model from ICT, and we're also going to be talking about his macros, and we're going to be combining the two for higher probability. So firstly, macros, if you haven't seen my other videos, watch that. I've got 2 videos on my YouTube channel, but a macro is a key time period where you expect the algorithm to deliver in price. It's going to do something important. It's going to raid liquidity. It's going to create a shift. It's going to set up the framework for you to enter a trade. That's essentially what a macro should do. And it's just a time window. So for the AM session, and this applies to Forex, this applies to indices, and this is for New York AM session, 9:50 to 10:10 is the first macro, and 10:50 to 11:10. And then notice how the silver bullet hour is kind of in between those two macros, 10 a.m. to 11 a.m. So it kind of sets up for that nicely. So this first macro, I just want to talk about it. And there was a long position here, right? Which is still completely valid. It didn't work out, but we'll talk about why maybe it didn't work out and also how you could have mitigated that later on. So in this macro, we've got a market structure shift above this swing high. Now I want to zoom out because in order to use ICT's methods, you first need a raid of liquidity, right? You've probably heard of people talking about raids, market structure shifts. You need liquidity to be taken. That's the first thing you need. There's a swing low here. There's liquidity underneath that. In other words, there's stop losses, right? We're taking out people's stops. And there's also liquidity underneath this swing low. So liquidity rests at swing lows and swing highs, and the market only targets 2 things: imbalances in the form of fair value gaps and also swing highs and swing lows. So those are the 2 swing lows, right? And they're big swing lows from previous sessions and previous days. And we sweep that. So in my eyes, once we've swept that sell side liquidity, I'm looking now for longs. That's how I frame my mentality when I'm entering the silver bullet, whether it's the London session, the New York session, whatever it might be, right? I also need a clear draw on liquidity, or I need some kind of target that I could be looking for. There's all these relative equal highs here. I like that. And there was also a 15-minute fair value gap somewhere around here. So I did have targets that price may want to return to if I was going to go long, which is something that is really critical. So for the silver bullet model, you need a rate of liquidity, which we had. We need a market structure shift, which you can see we have within this macro period. And then you need to return to a fair value gap. So the entry that was typical here was a long position from this fair value gap, placing your stop loss below this swing low and targeting a 1 to 2, or you could have targeted this imbalance, whatever you wanted to, right? But as you can see, price pushed up, right? Pushed up, broke past these last down close candles, which represent an order block, created a market structure shift, had some displacement, had a fair value gap. We returned to that fair value gap, but notice we didn't immediately displace out of it, right? So with fair value gaps, and I'm just going to draw this out, you really want price to displace straight away. Those are the best fair value gaps and the highest probability. A lot of people talk about, yes, enter off a fair value gap, but I'll give you a little bit extra. So with a fair value gap, let's say that's your fair value gap, and price dips in. If price does not close below 50% in this case and then displaces up, that's a good sign. If price closes and the bodies close below 50%, so for example, on this candle here, we close right at the end. If the next candle does not immediately rebalance and displace through and up, then the idea is that price is probably going to head lower, which is exactly what happened, because the next candle closed here, stop loss was here, it got taken out, and this got taken out too, right? So that's how you read fair value gaps, right? So with fair value gaps, the things I'll be kind of looking for is, does price close below 50%? For example, in this case, how do the bodies close, right? And what's the reaction? This is the third thing. What's the reaction from the fair value gap? Because that will let you know how high of probability you have in terms of the trade going in your favor, because you're looking at all these different things, right? These 2 candles here are an order block, a bullish order block. Last 2 down close candles before a push up, and you get the opening price of this candle, right? So notice we're hovering around that, but then we actually break lower. That's the first sign that price may not want to go up just yet. And overall, what happens here, you get stopped out, which is fine. So taking losses is, completely a part of the game. And what we're talking about today is how to mitigate that, but also how to use the macros. And in this case, you may have had a loss here, but you would have mitigated that, or you would have, managed your loss and had a win later on the session. So you can see here, we just sell off, right? As soon as we break past this low with this level of displacement, I'm not looking for longs just yet, right? So if you were, looking for longs right around here, I wouldn't be looking for longs yet, because displacement past an old swing low like this, after you thought it was going to hold, it probably means that we're searching for other sources of sell side liquidity or imbalances. And what I want to point your attention to is, if you zoom out, right? If you zoom out, there's this fair value gap here on the 15-minute time frame, right? That candle's low and that candle's high. It's a massive, massive imbalance, right? So if I just draw that out, and I'm going to extend that across in time so you can see how kind of that matches up. We haven't even touched it here. We came close, but we didn't touch it. And look at price. Look at price be drawn towards that fair value gap. And we'll talk about the behavior in a second, right? So you can see here, once you get that displacement down, this fair value gap's disrespected. You take a loss, maybe you risk 0.5%, maybe you risked 1%. Okay, fair enough. You take a loss. When price digs into this imbalance now, that's when I'd start looking for longs, with the idea that you're going to use the next macro time period. And what I'm going to do, I'm just going to change this to make it a bit lighter, right? So you can see what's going on. I wouldn't be doing anything here. I'd be waiting for the next macro. And look what happens in the next macro. And here's the beautiful thing about it, right? That's the 15-minute imbalance, right? This is the next macro. We get a rate of this liquidity here. We've already rated tons and tons of sell-side liquidity. We've got a market structure shift above this swing high. We've got another market structure shift. And this is really interesting, actually, how price actually behaves here, because you've got these two candles or three candles, right? These down close candles. When price pushes above those and closes above this level, I'll draw it out. When price closes above this level, that kind of indicates that there's a change in the state of delivery. And you might have heard that. When price closes above there, there's a change in the state of delivery from bearish to bullish. It's happening in a macro period, so we're going to trust that. And also when price breaks past this candle here, this body, that's also a change in the state of delivery. So you've taken out lots of sell side. You're tapping into a 15-minute imbalance, right? So you've done the two things that the market loves to do: take liquidity and fill imbalances. So you've satisfied those two things. You're in a macro time period. You've had a change in the state of delivery twice, once here and once there. Two market structure shifts. We're forming higher lows, so price doesn't really want to go down as of yet. And we're nearing the end of the silver bullet. So we're looking now for a setup in this macro period. And notice how once you get the change in the state of delivery once here, and we'll do another one here too, twice there, two market structure shifts. Yes, the entry comes after silver bullet, but notice, right, the setup forms within the macro period. So this is how you can use the second macro period. So if you're going to enter this, we'll get rid of that. You could have entered straight away off this fair value gap here, right there. Stop loss below this previous swing low, targeting whatever you need to, a 1 to 2, a 1 to 3, whatever you'd like. Because ultimately we do actually move quite a bit higher in terms of price. So this was actually a really good trade if you took this one. And what you see is that this candle, let me get rid of this. These set of candles here before a shift up, they represent an order block, a bullish order block. The top or the opening price of that candle, have a look at how price bounces off that here. That's perfect price delivery. So that is a bullish order block. We return to this imbalance here. We tap onto that bullish order block, and then price moves higher. And then again, we tap off this order block here, these last two down close candles before a massive shift up. Also could be considered a propulsion block. We tap off that, we push higher, we return to this imbalance here, and then we also push higher. So we're using these order blocks or propulsion blocks, depending on which one you're looking at, to actually move price higher. And that obviously happens for the rest of the lunch hour, and then PM session's a little bit different. But I thought I'd go through that because losses are a part of the game, and this fits all the criteria that I'd need to enter a trade, right? And that's completely fine. You take a loss here. Let's say you risked 1%, minus 1%. You're waiting patiently for the next macro. You enter another trade here. You go for 1 to 2 risk to reward. You've just made 1% for the day. So you don't end in negative. If you lost this trade and that's all you took, you're down 1%, but that can easily be mitigated on a second day or a third day, whatever it might be. But notice here that by using the macros, you can actually stick to strict time frames. So you're not wondering, oh, is this going to be the time where it changes? Is this going to be the time where it changes? as ICT says, like if something doesn't pop up in the macro, then just wait to the next one or reduce your risk, because this or yesterday, and it would have been the 4th of December, Monday, perfect example of how the macros are going to behave and how most of the time they're going to give you setups. This one here didn't, right? It didn't give you a setup for a long position. You may have gone short, fair enough, but if you're looking for longs, the macros in this case allowed you to be profitable for that day. So I hope that kind of helps. Just another video intertwining different concepts and how they kind of relate. If you've got any questions, leave them in the comments below. I'll be doing these types of videos more often. Whenever something really stands out, I'll make a note of it, because it's a really important concept. And if you just traded macros only and you only looked for setups to form as a result of macros, the probability increases dramatically. So hope that helps. I'll talk to you guys next time.